Hi students, O-Levels Online presents the video lecture series for Calculation and Understanding for Accounting Ratios. In this video, we will discuss the topic, the Profitability Ratios definition, and its types. This video series is helpful for those students who are appearing in Cambridge O-Level upcoming exams, either in June or November, through CAIE or IGCSE or IGCSE, 9-1. For accounting, 7707, or 0452, or 0985. Let's begin the lesson material. What is accounting ratios? Accounting ratios are mathematical comparisons of financial statement items used to analyze a company's performance, efficiency, liquidity, profitability, and financial health. These ratios provide valuable insights to managers, investors, and stakeholders for decision-making. Let's check its role. In accounting, accounting ratios play a critical role in interpreting financial statements, enabling users to assess the financial status and performance of a business. Ratios are broadly categorized into several types, each serving a specific purpose in financial analysis. Let's examine its first type, profitability ratios. Profitability ratios measure a company's ability to generate profit relative to its revenue, operating costs, balance sheet assets, or shareholders' equity. These ratios are crucial for assessing a company's financial performance and efficiency in using its resources to generate earnings. Let's check its kind, one by one. The gross profit margin is a financial ratio that measures the percentage of revenue that exceeds the cost of goods sold. It indicates how efficiently a company is producing or buying its products and services relative to its sales. A higher gross profit margin implies better control over production costs or pricing power, while a lower margin may indicate cost inefficiencies or competitive pricing pressures. The formula for gross profit margin is as under. Gross profit margin is equal to gross profit divided by revenue and multiplied by 100, where gross profit is equal to revenue minus cost of goods sold, and revenue is equal to total sales or income generated from selling goods or services. Let's check its example. If a business has a gross profit of $50,000 and total sales of $100,000, the gross profit margin would be, for the solution of 50,000 gross profit divided by 100,000 total sales multiplying by 100 is equal to, we will get 50% as a result of it. Interpretation is that 50% of the sales revenue remains after covering the cost of production. Let's check its importance. A higher gross profit margin indicates that a company has better control over production costs and/or strong pricing power. A lower gross profit margin may signal increased production costs or difficulties in pricing competitively. This ratio is important for assessing the company's basic profitability and operational efficiency, helping to identify cost management issues or opportunities for pricing strategy improvements. Let's check another ratio, net profit margin. The net profit margin is a financial ratio that measures the percentage of revenue that remains as profit after all expenses have been deducted. It reflects how effectively a company is converting its revenue into actual profit, and indicates overall financial health and profitability. A higher net profit margin means the company retains more of its revenue as profit. Let's check its formula. The formula for net profit margin is as under. Net profit margin is equal to net profit divided by revenue and multiplied by 100, where net profit is equal to profit after all expenses. Revenue is equal to total sales or income generated from selling goods or services. Let's check its example. If a company's net profit is $20,000 and its revenue is $100,000, the net profit margin is, for the solution of 20,000 net profit divided by 100,000 total revenue, multiplying by 100, is equal to, we will get 20%, as a result of it. Interpretation is that 20% of the sales revenue is retained as profit, after all expenses. Let's check its importance. A higher net profit margin indicates strong profitability and efficient cost management. A lower net profit margin may suggest higher expenses relative to revenue, pointing to inefficiencies or potential issues in pricing, cost control, or other aspects of the business. This ratio is crucial for assessing overall profitability and helps compare financial performance across companies and industries. It also provides insights into how well a company is managing its overall cost structure. The return on capital employed, ROCE, is a profitability ratio that measures a company's efficiency in generating profit from its total capital employed. It assesses how well a company is using its capital, both equity and debt, to generate returns. A higher ROCE indicates a more efficient use of capital, while a lower ROCE suggests that the company may not be using its capital effectively to generate profits. Let's check its formula. The formula for return on capital employed is as under. ROCE is equal to net profit before interest and tax, divided by capital employed, and multiplied by 100, where operating profit, EBIT, is equal to earnings before interest and taxes. Capital employed is equal to total assets minus current liabilities, or non-current liabilities, plus shareholders' equity. Let's check its example. If a company has net profit before interest and tax of $30,000 and capital employed of $200,000, for the solution of 30,000 net profit divided by 200,000 capital employed, multiplying by 100, is equal to, we will get 15%, as a result of it. Interpretation is that company generates a 15% return on the capital it employed. Let's check its importance. A higher ROCE indicates efficient use of capital and strong profitability, making it a positive indicator for investors. A lower ROCE suggests that the company may not be generating sufficient returns from the capital it employs, which could signal inefficiency or underperformance. ROCE is especially useful when comparing companies in capital-intensive industries or businesses with significant levels of both equity and debt. It helps assess how well management is utilizing available resources to generate earnings. The return on equity, ROE, is a financial ratio that measures how efficiently a company is using its shareholders' equity to generate profit. It indicates the return generated on the shareholders' investment in the company. A higher ROE signifies that the company is using its equity capital effectively to create profit, while a lower ROE might suggest inefficiency or underperformance. The formula for return on equity is as under. ROE is equal to net profit divided by shareholders' equity and multiplied by 100, where net profit is equal to profit after taxes for the period from the income statement. Shareholders' equity is equal to total equity from the balance sheet. Let's check its example. A company reports a net profit of $150,000 for the year. The shareholders' equity at the beginning of the year was $600,000, and at the end of the year, it was $700,000. For the solution of 150,000 net profit divided by 650,000 shareholders' equity, multiplying by 100 is equal to, we will get 23.08% as a result of it. Interpretation is that the company has a return on equity of 23.08%, meaning it generated a return of 23.08 cents for every dollar of shareholders' equity. A higher ROE indicates that the company is effectively using shareholders' equity to generate profits, making it attractive to investors. A lower ROE suggests inefficiency, or that the company is not generating adequate returns relative to the equity invested by its shareholders. Investors use ROE to evaluate how well a company is performing financially, and compare it with other companies within the same industry to make informed investment decisions. Return on assets, ROA, is a financial metric that measures how efficiently a company uses its assets to generate profit. It indicates how much net income is produced for each dollar of assets owned by the company. A higher ROA signifies effective management of assets and higher profitability, while a lower ROA may indicate inefficiencies or underutilization of assets. Let's check its formula. The formula for return on assets is as under. ROA is equal to net income divided by total assets and multiplied by 100, where net income is equal to total revenue minus total expenses, taxes, and costs. Total assets is equal to the total value of all assets owned by the company. Let's check its example. A company has the following financial information: net income, $150,000, total assets, $1 million. For the solution of 150,000 net income divided by 1 million, total assets, multiplying by 100, is equal to, we will get 15% as a result of it. Interpretation is that the company's return on assets, ROA, is 15%, meaning that for every dollar of assets, the company generates 15 cents of profit. This indicates efficient use of assets to produce income. Let's check its importance. ROA is a useful metric for comparing the efficiency of different companies in the same industry, as it provides insight into how effectively management is using its assets to generate earnings. Investors and creditors often look at ROA to gauge a company's profitability and operational efficiency, helping them make informed decisions regarding investments or lending. By analyzing ROA, businesses can identify areas for improvement in asset utilization and enhance their overall financial performance. Positively, you got the clear understanding of the profitability ratios as per your syllabus and examination point of view. If you have any query regarding the lesson, kindly ask in the comment section of this video. We will discuss the next topic, the liquidity ratios, in the upcoming video. You can download the related formats and lesson material through the link provided below. Thank you for watching. I hope you learned something new today. If you did, like and share video with other people to learn from it. And please subscribe my channel if you want to see more videos like this. Take care of yourselves. I'll see you in the next lesson. Goodbye.